Hello everyone, this is Andrew McNair from SWAN Capital with our September 2023 SWAN report. In this month's video, we're going to discuss some recent headlines that influence the financial markets and distill this information so that you can utilize it for your financial plan and your investments. Because we want to keep you informed every month so you don't have to listen to all the talking heads and the media pundits with their gloom and doom. But please stay tuned at the end of this video for a required disclosure statement. At SWAN Capital, our market outlook is positive, but we're keeping a close eye on all of the recent market volatility that we've been seeing lately. The latest Consumer Price Index, CPI, and Producer Price Index, PPI, numbers came in higher than expected earlier this month, signifying that the inflation rate continues to persist. Despite the speed that the Federal Reserve raised rates over the past year, driving inflation down further will require more work for the Fed and come with potentially real pain. The inflation reading in August ticked up to 3.7%, which rattled the market's preferred narrative. Gas prices and energy, the primary drivers of current inflation, were once again the main culprits. The record high inflation that we've seen and we saw from the shutdowns and supply chain issues has mostly been squeezed out, but driving down inflation to 3 and 4% levels is going to be difficult. The Fed will have to keep rates where they are and perhaps hike them even further. The problem with that is that higher rates will not influence energy prices, which will only be changed by current administration policy changes. So that's not going to solve the energy issues. And we've already experienced so much inflation that it doesn't even account for what pain we've already suffered with higher prices. Now that stimulus money and savings are largely gone, and those that are actually still spending more and more are running up their credit cards. The consumer is spending and keeping the economy going. But as August rolled into September, signs of weakness have begun to appear, and the markets are beginning to fret. August and September have been weak months for the market, largely thanks to higher interest rates. In addition, the 10-year U.S. Treasury note remains elevated. Its yield has been consistently over 4% since early August, and it clocked in at over 4.3%. And so as a result, concerns that the Fed would have to do more to tame inflation crept into daily dialogues. Here's the problem with expectations that the Fed will need to do more. Moving inflation from 4% to the Fed's desired 2% level would induce a recession. Recessionary fears are dominating again, and markets have floundered from one data point to another data point, trying to find a path forward. Now we have a looming government shutdown, a strike, and worries about the Fed possibly doing too much. That's a lot of headline risk. The United Auto Workers, UAW, decided to strike after contract negotiations stalled. After the deal that UPS workers struck last month, auto workers decided it was their time. The strike isn't industry-wide, but this is the first strike where all three automakers are being targeted simultaneously. Whatever side of the debate that you land on, the result will likely be the same. Prices for cars will go up again. Auto workers will get a significant bump in pay, although maybe not the 40% over the next few years that the union's looking for. Suppliers will probably increase their prices. Gas prices will remain elevated, giving everything that has happened to the auto industry in the past few years, from the pandemic to the electric vehicle push and the overall state of the economy, the strike will be problematic no matter how this turns out. Let's hope that the disruption is minimal and short-lived. Now let's talk about the job market. The BLS report, the Bureau of Labor Statistics, non-farm payrolls came in at 187,000 plus against expectations of 170,000 plus. Not tremendously off the mark. However, the unemployment rate ticked up from 3.5% to 3.8%, which seemed to obviously spook markets. Now, payroll gains for June and July were revised down by a total of 110,000, bringing the net gain to 77,000. Private sector payrolls rose 179,000 in August, but were revised down by 59,000 in prior months. We're keeping a close eye on these data points. Personally, I'm looking at buying a house and discussing with the agent about the seller situation. and that seller is facing a bankruptcy. And I haven't heard the word bankruptcy since 2010 and 11 and 12 when I was buying many of my real estate properties. So it's concerning that we're starting to see that the individual consumer is being stretched, that they're putting things on credit and they cannot pay their bills, and they're resorting to bankruptcy to actually clear the slate. So again, it is such important time to be up to date with your finances, to make sure that you have a financial plan in retirement. If you do not have a financial plan, we'd be happy to discuss with you how we actually build written out financial plans for our clients. If you have questions about your portfolio, about your investments, we'd be happy to stress test your portfolio. And we do this for many of our clients throughout the year when we are actually running the analysis on our portfolios. So give us a call at 1-800-848-8768. That's it for this month's SWAN Report. We look forward to seeing you next month. And again, if you have any questions about your portfolio, if you have questions as a client about how the allocations and rebalancing that we're making here at SWAN Capital, email portfolio@swan-capital.com. We'll see you next time.